This is John Dunleavy, and this is my explanation of the stock market. According to Google, New York Stock Exchange dates back to 1792, just a couple of years before my time. And of course, the big, widely heralded moment is 1929, the stock market crash, which set off the Great Depression of the 1930s. When I first started, became aware of the market and actually had any money to invest in the market, goes back to the Reagan period. 1980, I think, was he's elected and began in office in 1981. And for a long period of time, the Dow Jones Industrial Average was stuck around 1,000 for a period of years. Once the Reagan miracle, they called it back then, the combination of tax cuts and transformation of the economy really started to see growth back then in the Dow and the S&P, really going up until I think 1987, which was the period where we had another mini crash. They called it Black Monday, where I think the market lost like 20% in that one day, but it bounced back quickly. And then we probably had a pretty good up until the lost decade. If you were retired in 1990, the 10 years after 1990 were actually very good for stocks. But if you retired in the year 2000, a bad decade for stocks, they called it the lost decade. The NASDAQ had really gotten out of hand. It was overheated and then caused a recession. Then you had 9/11. And then, in 2008, of course, you had the Great Recession of 2008, and that all occurred in that 10-year period. And then following that, we've been kind of on a recovery period since then, up until we had the pandemic, but that was short-lived as well in terms of equity prices came back quite quickly after the pandemic. And then we had a brief downturn in 2022 until we get to this year, we've had a very volatile market. For the most part, I think 75% of the years going way back have been positive years for the stock market. The other 25% have been potentially bear market years, but the bear market years or the correction years had an average duration of 9 months, whereas the positive periods of time were much longer, like in the order of 3.5 years. So over time, it's been a benefit to be in the equity market. We expect that really is one of the few ways as well, not only to build value, but it's kind of the one place you can combat inflation as well, because equity prices have advanced at a higher rate than inflation. And that's, if there's a drawback to bonds or fixed income, it's that they don't keep, or being in cash, doesn't keep pace with inflation over long periods of time. The stock market really is companies that have gone public, have become publicly traded and no longer private companies. Most all companies start as private companies and then later become public companies. Really what you're doing when you're investing in stock is you're buying a little piece of the company and you're sharing in the fortunes of that company. If the company does well, stock price hopefully goes up. If the company starts to mature, they'll start to pay a dividend. Dividend, of course, is a whole nother strategy for investors. There's a whole segment of the market that focus on dividend-paying stocks. Really, the two primary ways you benefit is if the stock goes up or you get cash in your pocket via the dividend. A third way you can profit is a company could do share buybacks. And generally, a company that has strong cash flows and wants to reward the investors can go in the market and buy their own stock and retire it, helping to elevate the stock price. But the different sectors of the stock market, as I said, you can buy a piece of a company when you buy a stock. You've got the S&P 500, which really are the large capitalization, the big companies. You've got the mid caps, which are kind of a tier below, and then you get small caps. And then you have the Russell 2000, which is kind of a compilation of smaller companies, which is widely followed. The further you get from the large companies, the less efficient they are because they're less covered by the street. Could be more volatile because of that. And that's why most people, or a lot of people, tend to be overweighted in the large company or the S&P 500 stocks. It's commonplace that if you have a particular interest in a company, whether you've worked there or you have knowledge of the company because you live in that area, there are times that you want to buy individual stocks versus owning an index like an ETF. Monorail, of course, you could do that on Monorail as well. We have a low fee structure for do-it-yourself investors, and that can be as low as 3 basis points. It's a good way to get started in the market. But as I mentioned earlier, before you start investing in the market, you really should set yourself up with some emergency funds so that you don't have to pull your money out of the market if something comes up. You know, you need a car repair or a leaky roof. Those are not really reasons you want to have to pull your money out of the market, because time in the market is a key component of building wealth. Thanks very much for watching, and we hope to see you again on the next video.